Okay, welcome to this week's Middle Class Investor. We're looking at a chart of the S&P 500. Um, we're looking at a 2-year chart, so you can see that most of 2014 we just chopped sideways. Really into 2015, where we fell off with this pretty good zigzag pullback, and then the market's been trying to go higher, but is struggling. And I'm showing here, we talked a couple of weeks ago about how one of the things I'm observing here is these thrusts are getting shorter. So if this is through going down, which it may or may not be, I don't know, but if it is through going down, we're probably looking for a thrust that's smaller than this one, which was smaller than this one. So keep that in mind as you're deploying your capital and trying to figure out what to do with your money. There was a lot of talk about the Fed. A couple weeks ago, I came on here and said they're not raising interest rates. That's not unusual. A lot of other people were saying that too. So there's nothing special going on here. I don't want to mislead you guys. We were talking about that basically, this 13-week Treasury would need to close and remain up here in order for the Fed to raise rates, because what they're doing is they're following rates. And I still haven't put that video up. I apologize for that, but I do plan to put a video up that shows how the Fed follows rates. You just need somebody with some discipline to actually track their announcements versus what the market interest rates are doing. And this guy online does that and shows you, and I'll copy his video and put it up. I should have already done it, but it just has slipped my mind. So apologize for that. Let's look at the 10-year. The 10-year, is back in our channel. We talked about needing to see the 10-year. Hold on a second. There's the channel right there. So we talked about needing to see the 10-year kind of poke its head above this, like here, and then maybe pull back and test the channel, and then start to bounce. And we have not seen that yet, so interest rates could very well make another leg down. In fact, if you're trading, I know I've called for bonds, being out of bond funds, but you could still be in your bond fund. Just pay attention that if this comes down and it doesn't make a new low, let's say it makes a higher low right there and starts to travel upward, that's probably a good sign that this is the low in bonds, okay? In other words, you don't have to wait till it breaks the channel and then pulls back. You could actually, if it does not make a new low, you just the best way to gauge that is this is a daily chart. Let me pull up a weekly. So on a weekly chart, here comes that coughing attack. I can feel it. You can see here's your low, and then we had a close above, and then notice the market drifted up over the next several weeks. So let's just look at this in more detail. We had a low right here, and then the next week we had a close above this high right here. So it closed up here. I'm sorry. I was hoping that wasn't going to happen. Just can't avoid it. And then you can see rates pulled back, but then they drifted higher over the next several weeks. So if this pulls back to a higher low, higher than this one right here, and starts to, show something like that, then, this would be a good time maybe to step aside on bond funds. The reality is there's not that much money to make in bond funds anyway. Yeah, you could probably on a let's say you had $250,000 in bond funds. If rates went to zero, you could make maybe $50,000 on that bond fund, which is significant. But if rates go, to 2.5 from here, you could lose $50,000. So just, I don't know. It's your money. Everybody has to make decisions about their own money. But what I'm trying to ring true here, trying to bring out is that bonds are considered safe, but bonds and bond funds are not the same thing. Most of what you have in your 401k are bond funds. Now, you could go out into the market and you could buy individual bonds. You could buy, like, say, a 7-year, a 5-year, a 2-year, a 1-year. And then every time a year goes off, go out and buy another 7-year. And always be rolling your bonds. That's called laddering. But that's not the same thing as owning a bond fund in your 401k. So I just want to make sure people understand that. The reason is, if you have a bond, the bond has a face value or and a maturity date. Golly, sorry about that, y'all. So the face value, regardless of where you bought the bond and regardless of what happens to interest rates, at the end of its maturity will have that value, that face value. So you can't ever lose more than the face value of the bond unless you sold it early. As long as you hold it to maturity, you get the face value. The bond fund does not work that way. If the yields go down, the mix of bonds and the bond funds are recalculated, and the bond fund's given a value. And that's a little bit different. All right, volatility. Volatility has been low for some time now and has maintained areas. Its range has been down in this area for a while. And really, until volatility, consistently, gets above 20, it's probably just going to stay in this range. So usually it means probably the market is not through going up, as we showed on the S&P 500 chart. There's probably still some more upside to the market, albeit minimal. So just keep that in mind. Let's see. The Nasdaq. Let me go to the Nasdaq 100, because that chart may have already topped. I mean, it's looking somewhat toppy. You can see, maybe not. It's hard to say just yet, but you had this low back on, when is this? August 2015. Run up. I don't know, you might have another down up in the Nasdaq, maybe, but the Nasdaq looks like it doesn't look as strong to me as the S&P 500. More or less in a sideways trending range. It's sideways to up here, but I don't know. There's just something about the way the Nasdaq is trading that's got me a little bit suspicious of it. Maybe some of the money is going to start coming out of those technology stocks sooner than in the broad market. Okay, let's switch over to the dollar. Here's the U.S. dollar. You can see since, 2008, it's been generally up. We had a really strong run up here in 2014, which really drove oil. This is what drove oil down. Some people, they talk about the fundamentals of oil and they wonder what OPEC is doing and all that kind of mess. It really doesn't matter, because the dollar, oil is sold all around the world in dollars, and so what the dollar is doing has a lot more to do with oil than what OPEC is doing. So, that's not to say these charts are inverses of one another, but if the dollar's strong and getting stronger, then oil's going to be going down. And if you look at oil, you'll see that oil's been chopping. It's kind of range bound, and they're talking about it being range bound for some time. I don't know if that's going to happen or not. I think it's going to make another leg down as the dollar makes its move up into this area here. So we'll see how it plays out in the marketplace, but let's just look at crude oil real quick. I thought the dollar had bottomed out here, but it's still kind of choppy. So I mean, it could make a new low. It really seems like it would have taken out sooner than it has. So here's the long. This kind of corresponded with the rise in the dollar here. And when the dollar started chopping sideways, oil was still falling, but then it stopped, and now it's kind of chopping sideways. And it might make it back up into this area around 55 before it rolls back over and goes down. That would have to mean, though, that the dollar would go down, and the dollar doesn't look like it wants to go down from here, but who knows? It certainly could. Anything is possible. We're kind of in an area where it's really hard to tell what's going on in these two markets. The euro to me looks down, looks like it's wanting to go down. So that tells me that the dollar wants to go up, which tells me that oil wants to go down here in the intermediate term. But they are in a place where it could go either way. So it's one of these things where you just kind of stand aside. If it's not real clear, you kind of stand aside and let the market kind of do whatever it's going to do without you. Let's look at gold. Gold, ever since gold hit this kind of DP resistance area, it's just chopped around. So I thought maybe it would go down here, but sometimes when you get this chopping around, this is a consolidation pattern. So what I mean by that is, the market has a strong move up like so, and then price tends to consolidate around a range like a triangle or whatever before it breaks out again to a new high. So I don't know. My initial thought when we were back here is that gold would pull back to here and then make a new run up, up into this area. But this triangle / consolidation pattern has got me thinking that oil's probably going to make a move up from here. So we'll see. I mean, gold. So we'll see. It's more clear than oil, but not much more clear. So silver, kind of the same. You can, especially when you're looking at it from far away, kind of see this triangle, kind of pennant / consolidation. You can kind of see here, which means that silver might have one more leg up and then come down like so, like that. So we'll see. Again, when things are clear, that's when you want to maybe take a position. Things were more clear down here for going long. Things are not as clear right here. So the currencies are starting to get kind of interesting. Let's just look at the euro US dollar. You can see I've had what I thought was going to happen there, and according to what I thought was going to happen, we should have already started moving down in the euro, but that's not happened. So I would say if we do get a candle that looks like this, maybe I'll go ahead and take a position for lower prices, because I am expecting this next move to actually break out of this triangle. It won't just come here, and bounce like that. I'm expecting it to break through the triangle, and when that happens, a lot of selling will, the ferociousness of the selling will pick up, and the prices will quickly accelerate here down to below the previous lows at 104.50. So you should see the euro moved to, maybe 102, 101, maybe even 1.0, parity with the dollar. So, a lot of the Asian markets are doing a lot of printing of money. So you got, some pretty big moves. This is the Swiss franc, Japanese yen, and, the yen, the Japanese are just printing and devaluing their currency like crazy. So this is a pretty significant move down, and I would say that it's at least going to go into an area below this consolidation here. So maybe something like this area before it even slows down, and it could go even further. I mean, if you recall, going back to oil, when people were trying to predict when this move was going to stop, we were picking zones like below here, and of course it just blew right through that. The zone here, every one of these lows is potentially a DP support area, but you can see that oil just blew right through those. And the same thing could happen on these currencies, like the Swiss franc dollar yen, or Swiss franc yen. I mean, it could just blow right through this. So, I don't know. We'll see. That is really about it for this week, y'all. Again, I don't want to get into a coughing attack, so I think I'm just going to cut things short. Sometime this week, I'll try to post some of those other videos that I said I would post, in case you're interested. If you have any comments or questions or anything, post those on the YouTube comment section, and we'll get those answered or replied to, depending on what the comment calls for. Other than that, thanks for coming in this week, and we'll talk to you next week. Goodbye, everybody. Take care.